Peter, I'd like to discuss further this concept of a foreclosure freeze that's making the headlines. You know, the latest twist in the real estate Armageddon. And as we're hearing now, major lenders such as Bank of America, well, they had some folks who were simply signing off on up to 500 foreclosures a day without taking a close look at the paperwork. I understand that many people are expecting this to save them from foreclosure. What I'm more concerned about is that this could just perpetuate our housing dilemma, discouraging buying in the sector. Many people are concerned about who owns what.
That's another problem, too, is people don't want to buy the homes that are being foreclosed on because they're worried about how secure the title is. And so, yeah, I mean, it is a big problem. You have to remember, everybody wants to feel sympathy for the person who is losing the home. But these people don't own those homes. The banks do. And it's not like you're talking about somebody who owned a home free and clear and took out a small mortgage because they got sick, and now all of a sudden the bank is foreclosing. I mean, probably 99% of these are people who bought homes that they never should have bought in the first place with little or no down payment, or people who borrowed against their homes that they already borrowed to buy, and they borrowed against the homes to take vacations, to buy new cars, to put in swimming pools, and they can't afford to make the payments. So, big deal. They move. Most people who are losing a home in foreclosure, you're not talking about people out on the street living in a garbage bin. You know, they have plenty of money. They can go rent a different house. They can rent a house that they can actually afford. They do not have a right. People do not have a right to a home. Just because they occupy it doesn't mean it's theirs. If they didn't pay for it, it's not their property. You know, you don't even, when you go and buy a car, until you pay off your loan, the car belongs to the bank. They've got the title. So just because you buy a house using the bank's money, it's the bank's house until you pay off that mortgage. And if you can't make the payments, the bank's entitled to take that property. And everybody wants to have sympathy for these home buyers. What about the lenders who loaned all the money? You know, that's where the real losses are going to go. The homeowner just picks up and moves someplace else, and he sticks the lender with all the losses.
Peter, but let's not forget that it's also John and Jane Q. Public who are going to be stuck with this bill.
They're part of the lenders now because the government has basically guaranteed those loans, so now they're sticking the taxpayer with the loss. The guy that has the least to lose is the person that we're all supposed to feel sorry for, the homeowner. Why should we feel sorry for this guy? He bought a house with somebody else's money, couldn't pay it back, and so now he's moving to another place. I mean, there are plenty of people who are renting right now who never bought. Why should they feel sorry for somebody who's now going to be put in the same position that they're in?
Peter, at the end of the day, I'm sure you'd agree that it really was the government's policies of allowing anyone with a pulse, anyone who could fog a mirror, this almost divine right, if you will, to own a piece of property. That is the number one overriding thing that got us into this mess.
Oh, yeah, and I think, because the government layered our economy with so many taxes and regulations, they make it so difficult for people to get ahead that the only thing they can do is hold out this carrot of easy wealth through home ownership. Because they made it so much more difficult for us to achieve wealth the old-fashioned way by earning it. They said, well, everyone's going to get rich by buying a house.
Let's talk a little bit about the precious metals bonanza that we've seen in the past few months. As you pointed out, the dollar on a race to the bottom, and the greenback in a lot of trouble. Of course, that's one important component of the yellow metals emergence here as the currency du jour, if you will. However, there are many other factors at play.
Yeah, well, unfortunately, the dollar is going to win that race to the bottom. I don't even think it's going to be close. But and I don't think we've even gotten started. We've barely seen anything yet, I think, in this precious metals bull market. I mean, even today, with gold up $20, a new record high, look at the gold stocks. I mean, yeah, the Huey's at a record, I guess, but it's barely making new highs. These gold stocks should be on fire right now, but they're not because there's so much fear in the gold market. Everybody thinks it's a bubble. Everybody's waiting for the price to drop. They've been waiting for that for years. It hasn't happened. So I still think that we have huge moves going forward, particularly in the mining stocks, which I think are grossly undervalued, not only given where gold is right now, but where gold is likely to be a year or two from now. None of that is built into these stocks. I think the stocks are already pricing in a big drop in the price of gold, and I think that's not going to come. So maybe we need some earnings to come out from some of these gold stocks. way above estimates to get people thinking about it. Maybe we need another couple of key takeovers. Maybe we need a takeover of one of the majors or something, maybe by a sovereign wealth fund or something like that to get the markets moving. But I think we're going to see much bigger moves.
But don't you think, Peter, that one of the components that could be weighing down on the XAU and the HUI are the emergence of many of these gold funds where folks can come in with ETFs and double and triple leverage on many of them? That must be directing a sizable amount of investment and capital away from the traditional gold stock play.
Well, it could, but if these ETFs are there, then in order to create the shares, they have to buy gold. So the fact that there's such a big interest in ETFs, these ETFs are major customers of these gold mines because they have to have gold. So unless the ETFs are fraud, more demand for ETFs is bullish for the earnings of gold companies, which should be bullish for their stocks. You know, in the short run, maybe some people are opting to buy the ETFs, but ultimately that is going to have to feed through into higher earnings. And then when people start putting multiples on those higher earnings, you get a lot more leverage to the upside. And, of course, you can buy gold stocks on margin, too, so you can leverage that leverage if you want to. So, and people can buy, call options on mining stocks. So there's a lot of ways to get leverage in the mining sector. Unless maybe people are afraid of huge taxes on these gold mining companies because they'll be some of the only companies that are profitable. But if they do that, then they're just going to diminish. They're going to take the capital away from the gold companies that they would need to reinvest in finding more gold, which is only going to push the price of gold even higher.
And as we wrap up here, Peter, wouldn't you agree that one of the major arguments in the deflation camp was the fact that silver stubbornly refused to move along with the yellow metal? Well, that came to an end 2 months ago. For almost 8-9 weeks now, nothing but higher highs in the silver camp. Is that the final nail in the deflationist coffin?
I buried the deflationists a long time ago. They don't understand. Whenever there is an inflationary boom, you have a deflationary bust. The deflationary bust is healthy, okay? But that assumes you're on a gold standard. Okay, we're not on a gold standard anymore. So you can't look at, prior periods of inflation, deflation that happened before we were on a fiat currency standard. See, the problem is when you have the deflationary bust with a fiat money, the central bank can stop the deflation in nominal terms, which is exactly what it does, because politically it doesn't want to allow it to happen. But it happens anyway. You see it in the price of gold. So if you look at what is happening to prices in the world, whether it's the price of assets like stocks or real estate or even goods, prices are falling if you measure them in gold, right? So from the deflationist perspective, they're correct if you thought things would deflate in terms of gold, because that is exactly what's happening, and that is exactly what I said would happen. I wrote it, and I've been saying it all along. Prices in terms of gold will deflate, but they will not in terms of U.S. dollars, because the dollar will lose value even faster than the prices that we're using to measure it. So when you price things in dollars, prices go up. So you don't have deflation the way most Americans would think of it. Most Americans would think of deflation as my cost of living goes down, things get cheaper. They're not. They're getting cheaper if you have gold. Believe me, things are a lot cheaper for people today who have gold, but most Americans don't have any gold. All they have is dollars, and for them, things are getting more expensive. And the danger is that they create so much inflation to counter the market forces of deflation that we have hyperinflation. That is the real risk, that they destroy the currency completely. Now, in hyperinflation, prices will collapse in terms of gold. I mean, things will be dirt cheap. I mean, you'll think about all the things you'll be able to buy with just 1 ounce of gold. But in terms of dollars, I mean, look at what happened in Zimbabwe. I mean, what can you get with $1 trillion Zimbabwe dollars? You can't even buy a pack of chewing gum, but you can certainly buy a lot of gum if you got an ounce of gold.